Hello, I believe we're live, and welcome everyone. Thank you very much for joining us today in what's shaping up to be one of the most anticipated webinars we've hosted. Today's topic dives into the belly of the beast, bringing us the perspective of one of the most forward and involved professionals in the uptake structure of RWAs. Hi, Philip. Yes, you can respond.
Hi, Rodrigo. Lovely to be here.
Very happy that you can make it, Philip. We'll do an introduction into more about Philip's background, but firstly, I'd like to set a baseline. So, apart from the fact that any token that carries transactional value based on a legitimate business contract can essentially be tokenized and turn into a digital asset. This is what's implied with the term RWA, real value from the real world tokenized. Now, forming these and having these traded offers a wide set of possibilities that, if without proper guidance, can be a steep climb to navigate. Philip here is quite the authority in the field. He's the Senior Business Development Manager at 21X, Europe's first regulated DLT trading and settlement system. He focuses on go-to-market strategy, institutional partnerships, and the integration of regulated market infrastructure across Web3 and traditional finance. So he sits right in the middle of the action. His work supports compliant access to tokenized financial instruments under the European Union's DLT pilot regime and Germany's crypto securities register framework. So you can see, quite the man in the industry. Welcome, Philip, and thank you very much for joining us today.
Thanks for the invite. Lovely to be here, Rodrigo, and thanks for the lovely intro.
Least we can do, Philip. We'll start you easy to warm up. So let's talk a little bit about adoption. How are more people and markets starting to use tokenization?
Yeah, perhaps give you a little bit background around 21X and how we see the market developing, or I personally saw the market developing over the last 8 years now, since I started working in tokenization, first in a self-employed role, then as a startup founder myself, from a regulated market maker, now to the trading venue and settlement system, first one in the EU. So how are markets evolving, and who is actually using RWAs today, and maybe who will be using or adopting RWAs next? I think last year was the first glimpse, right, where we saw, okay, public equities going into the masses. Every centralized exchange is announcing, oh, we're adding 25 times 5 or 24/7 trading of public stocks like Nvidia, Tesla, Apple stocks. They all have different caveats, all have different solutions, but they're all going into the, I would say, right direction and expanding from a pure crypto-based platform into a crypto plus RWA platform. All have this vision about being this omni-channel platform, your one-stop shop if you are looking into investments, and this dismantling, so to say, the strategy of just being the pure crypto player. I think that is for the retail space. Also the key enabler. If I'm, for example, a Coinbase customer and I love the platform, and this platform is now opening themselves to RWAs, I would be willing, so to say, to give it a try, perhaps instead of using my third, fourth, fifth app for like special investments into public equities. I instead do it on Coinbase, where I have my crypto anyway, right? And then secondly, I see this wave of private credit and fixed income and money market funds, right? But more from a professional, institutional perspective. So the retail are all in for high yields, right? High return, AI stocks, energy stocks, stuff like that. And the professional and institutional players are more or less looking into tokenization and how do we gain efficiency with our existing processes? How do we get more utility into our money market funds? How can a market maker, for example, use a tokenized money market fund instead of stable coins as a collateral on an exchange where he is active? So there are different topics, different motivations, turning different kind of segments, customer segments, in again different kind of assets, which are all tokenized and living on public, private, and hybrid approaches.
Thank you. Very interesting what you were mentioning about not going on my fifth app and having this be integrated. So that's a very exciting perspective. If let's say crypto.com or Binance had now an RWA section, of course this would have to be gated by country of access for it not to be extremely chaotic with securities commissions all over the planet. But since these are global companies, I mean, it's very, very cool to think how that would be segmented, and definitely an exciting possibility. They have all the audience already, so I see where you're going with that. Cool. All right. Now, as for compliance, the scary monster a lot of people fear. In practical transactional terms, what is enabled now that wasn't before, and how do you consider it a breakthrough?
So what we see in the industry is those tokenization players are concentrating on certain regulatory frameworks. And this would have been possible 2 years ago already, or 3 or 4 or 5, right? But it wasn't just, there was nobody doing it, yeah? And there were a lot of trial and error. And some of the tokenization players, like, for example, Xstocks, they have changed the complete legal structure on the way, on the get-go, right? So they might have started with a different governing law or different securitization vehicle before, and now more or less every one of the major players have identified some jurisdictional framework. For example, on the global markets has chosen BVI for the global hub of public equities, and then the Swiss DLT Act as a governing law of the debt instrument they are issuing from the securitization vehicle. So you see these tokenization players are not only tech providers any longer, they more or less are now specialists in global securities laws. And they do what we call regulatory arbitrage, and that they do in a very fascinating, a very professional way. So they have identified the mix between where do I set up my tokenization issuer, so the issuance vehicle, and which governing law, which they're free to choose anywhere in the world, for debt instruments at least, should I choose for the tokenization itself. So they've gone from pure technology innovation to combining innovation in tech, using DLT, using smart contracts, and using appropriate legal frameworks to combine those two topics. And only if both the regulatory framework and the technical framework match towards aim I'm aiming to, for example, retail distribution globally across the world, right? Both of these components need to be tailored to fulfill this aim.
That's a very interesting take, Philip. The BVI space, I mean, and definitely that it rang the bell immediately, because we've spoken about you and I about a client we have with a BVI structure, and then their actual operation is not there. They're just structured there as for the origin, and they deploy in the EU. Not exactly as you were saying, but yes, in a parallel. So I see that being replicated, and definitely is doing a lot for the digital asset mobility. Now with infrastructure, we're clear that the technology is there. Tokenization technology is not new anymore, and now the legality, the frameworks permit to execute the dream that once was tokenization a few years ago, as old timers in the space, you and I, and you much further back. Now, As for venues where tokenized projects are available to the public, how far are we, and where are we headed? Feel free to break this up into primary and secondary markets for our audience, and feel free to be as educating as possible.
Okay, sure. So you would have to have a dedicated look at the jurisdictions. And I'm again taking the public equities as an example. So a centralized exchange, let's take OKX, for example, or Brickken, might have a global audience. But they have different legal entities with different licenses across the globe. And they might launch a global announcement that RWAs are now available across the platform. But then in the little terms and conditions, you see a large list of countries which are still excluded. And most likely, or in most cases, you will find all European countries being excluded, the US being excluded, right? So they launched these offerings in countries where there's no dedicated framework or legal framework for the distribution of securities, and European customers, for example, to participate in such offerings. But more and more down the line are now entering the securities markets and the regulatory frameworks here in Europe to expand these offerings. So we see the likes of Brickken, for example. They have not only a MiCA license, or markets and crypto assets, which is our regulatory framework for crypto assets like Bitcoin, Ethereum, other utility tokens, but they also went all the way for the MiFID, our Markets and Financial Instrument Directive framework, which governs all equity funds and debt instruments here in Europe. So they have obtained both of the licenses. They can offer in a regulatory clean and compliant way security tokens like RWAs to retail investors across all of Europe. And we see this as an evolving process across many players. So they all started within crypto, and they are now evolving into this multi-platform around the globe. And within special jurisdictions, like the European Union is one of them, they are applying for special licenses, like MiFID, to be able to distribute those RWAs here as well, and not only to outside of the European Union customers. And with primary market, there I see a different approach. So on a centralized exchange like OKX, Brickken, Binance, Coinbase, those customers are more or less used to secondary market liquidity, instant processes. They want to trade the RWA like they trade the Bitcoin. And of course, a primary market transaction is a little bit different towards that. I go through a subscription process. I have a fixed price, for example, of a bond of €1, and I buy it directly of the issuer instead of another market participant. And there in Europe, we had, well, I would say it started all with crowdfunding platforms back in the days, like 8 years ago. And all of these platforms are primary market issuance platforms, which have started under MiFID to distribute traditional securities, and which have, during the last 6 years at least, developed to using tokenization as a technology enabler to attract more and more customers around Europe. So those didn't concentrate on secondary market liquidity at all, but solely focusing on primary markets.
So these are crowdfunding communities or platforms that already sell tokenized vehicles. So
exactly,
like Republic, for instance.
Mm-hmm. Yeah, absolutely. That's a good example. Or in Europe, I think Investor is one of the largest platforms in Europe, operating, let's say, pan-Europe across different jurisdictions. And they have, so to say, provided access to SME investment opportunities before there was tokenization, right? They were already active. And during the last year, they adapted more and more of their offerings onto DLT. Thus, as an investor client, I have now an integrated wallet access. I might as well be able to receive some of my dividends in stable coins instead of fiat. So it is an evolving space, and those entities have been, so to say, specced with the right licenses from the get-go.
All right, so the licensing layer seems to be permeating over to centralized exchanges. So spaces like Coinbase, Kraken, OKX, and also to where the adoption of fragmented assets has already been there. So crowdfunding, which is basically providing the liquidity, because well, yes, we see at Brickken a lot of clients sometimes that are coming in expecting to have the instant liquidity like you do on an exchange, and I mean, on our side of the table, we see it as like, no, this is not how things work. But why would they not think that when their experiences in the space work like that? It's understandable that they come to that conclusion, and it will be very interesting how what you see happening in centralized exchanges is able to provide there, and what happens when these things go live. I, for one, feel a bit excited to see it play out like an experiment in a few ways. All right. Well, yes, go ahead.
Yeah, perhaps also maybe some critical observation of this. So what we have seen during the last, especially 6 to 12 months, is that for many smaller crypto native brokers, for example, they have gone through this rigorous process of being regulated under MiCA to provide access to cryptocurrencies. And now a lot of the customers are asking, I see this offering of tokenized stocks everywhere. Can this be made available on your platform as well? And most of those are way too small. Like the effort to be governed under a dual framework in Europe, one for crypto under MiCA, and the second under MiFID for securities, that is a challenge only the larger centralized exchanges can accompany with. With a lot of also small players, this sets them into a disadvantage.
Yes, these licenses are very regulation heavy.
Absolutely.
We understand that ourselves being in the space, and it's for sure a barrier of entry. You're absolutely right. Now, if the licenses are in place and things are quote unquote good to go, right? So let's venture a little bit on here. We've done a few definitions, so moving forward, let's turn up the heat. What options are there for business vehicles so that a private business is able to offer a tokenized asset that makes sense for them? So, in other words, how would you and who would you recommend this to, and where does it not make sense, or at least not make sense yet?
Generally speaking, right, at the beginning of tokenization, a lot of startups thought they could use tokenization for a more efficient or maybe even easier way to raise capital. That has been, I would say, a false assumption. A lot of the projects did not get the right attention or didn't raise the amounts they hoped for. And down the line during the last years, it has become more or less clear that it does not replace your seed funding round or pre-seed funding for a startup. But what it did and where it was most successful is, I would say, in this SME or even larger corporations, which already have an established client relationships, which are not 100% dependent on this capital raise or tokenization, and which have come to the conclusion that tokenization and RWAs are part of the financing mix. So they might have some debt from the bank, they have some equity from existing shareholders, they might have some mezzanine financing, and additionally, there's now a new digital form of the financing mix, which is tokenization, and a lot of the instruments in the past have been debt instruments. So we see a start in equity raises, but predominantly like 90 to 95% of today's market is dominated by debt instruments of SMEs who do not or have no access to public capital markets in itself. So they are non-listed companies which are looking to attract retail investors or public investors with the offering. And this might have been fixed bonds, but most likely or most predominantly we have seen debt instruments which have some kind of fixed yield plus an additional variable yield depending on the performance of the company itself. And I would say there's a certain sweet spot for companies which have a, let's say, B2C relationship, perhaps, right? Somebody with a branding. Let's take an example. I'm a web shop for running shoes, and I have 1,000 or more customer touch point every day, and I'm monetizing it right through selling running shoes, but I could also potentially target those customers with a offering to participate in my token offering, right? So I advertise on my website or with every order that there's now the possibility to become part of a success story, right? You're my year-long, very valued customer. You've seen the growth of the web shop. Would you like to invest into this company? And what is the beauty of tokenization in this context? Why does tokenization make so much sense? It is because with a traditional bond offering, for example, my customer would need some kind of specialized brokerage account to be able to subscribe to a primary market subscription of a new financial instrument. But with tokenization, it is just enough that your customer has a smartphone, which 99% of them will, and they can open up a wallet in seconds, or they already have one, or you provide one integrated in the subscription process. So the potential audience of participants just is way broader with tokenization than it is without, and especially for corporates which have existing client relationships, especially as B2C brands have. They really can leverage this potential.
Okay, so very loud and clear there with the proportion. So 90 to 95% of instruments out there for private businesses, private credit. So that is, I guess, the market indicator of what offers a tangible opportunity for tokenization for private business. Okay, very, very clear. And now on the topic of permission and permissionless, just for a little bit of context here, to make sure everyone we're all in the same tune here. In very basic terms, permissionless tokens are what you find on crypto.com or Binance, these centralized exchanges that you can access through just simply opening a wallet, and you can go buy some Bitcoin or some Ethereum or some meme coin or whatever you're interested in. And permission tokens are quite different. Could you please give us a rundown of what defines them and their differences, Phil?
Mm-hmm. So most of the offerings we see are permissioned in the sense that the primary market creation with the issuer direct is always permissioned. So if you would directly mint a token at the issuer, you will need to go through a KYC and onboarding process. But with the permissionless tokens, there are no further transfer restrictions. So if I go through the KYC process at the issuer and I want to sell it again to, for example, you, Rodrigo, I can just transfer it via a normal transfer triggered through my MetaMask wallet, for example, without any problem. It's ERC2 or 20
no
compatible.
Whitelist, no filter.
Exactly.
Transfer.
Just like a stable coin. There might be a blacklist with restricted addresses, but it's very similar to how I would send you USDC from Circle. It's issued by a central issuer, unlike Bitcoin, right? But still, it is permissionless. And then this gives me some advantages. For example, why do I tokenize? One of the big promises of DLT and tokenization itself was composability, or is composability, in the sense that my token is composable with other applications running on the same DLT technology. For example, lending protocols, collateral use cases, decentralized exchanges, Uniswap, etc. And with permissioned token, not only the subscription and creation at the issuer would be permissioned, but also if I want to send you my permission token, like one of these tokenized institutional money market funds, for example, you would also need to be registered with the issuer itself or the transfer agent and go through a KYC and onboarding process and whitelist your wallet address before I am able to send you this token. And this works fine in closed ecosystems. Let's say you and me, we are both users of the same platform, right? This might be a viable idea. But again, then I lack the composability of transferring this token outside of this platform where I bought it and use it at Uniswap as a liquidity provider, for example, or at Morpho to do some optimization of my yield by looping it. And there are first concepts of how to, so to say, use permission token in DeFi applications. But I see somewhat of a challenge here because DeFi is such a fast moving space. And if I'm a user of a certain protocol, which just started last month, and I want my token to be composable with it, I don't want to wait a year, right, or two before it was integrated with certain requirements and the issuer of the permission token puts towards such DeFi applications.
Okay. So private issuers under private ecosystems would, I would think, have to issue a permissioned token. Is there a way for them to take advantage of permissionless ecosystems as a private issuer? I'm asking, like, let me rephrase. Is there a loophole or a specific regulatory approach I can take to originate as a private asset but gain access to permissionless trading?
Yes, most likely. So to put it in simple terms, I have the decision as a private company to issue equity or debt instruments. But there's a huge difference in choosing equity over debt because equity is always governed under the jurisdictional framework where I'm based. So if I'm a German company and I'm issuing an equity instrument, like a share of my company, this share is governed by the regulatory framework of Germany itself. And in Germany, I have the beauty of the Electronic Securities Act. So I have the theoretical opportunity to tokenize my equity. If I might be a Polish company, I don't have this option at all, right? There's no legal framework for me to leverage to even tokenize equity at all. But any company in Europe and even in very large parts of the rest of the world have the opportunity to choose the governing law of their debt instruments. So it's totally fine for me as a German company or a Spanish company or any company anywhere else to leverage, let's say, the Swiss DLT Act as a governing law of my debt instrument. So a Spanish company can issue a corporate bond which is governed by the Swiss DLT Act or governed by the German Electronic Securities Act. That is all possible. And this is, again, some kind of regulatory arbitrage because, of course, in that case, I would choose a governing law which is compatible, again, and allows me as an issuer to issue permissionless tokens or tokens which are composable with DeFi applications. So I would, for example, need to KYC my subscribers, so the investors who are participating at the primary market subscription. And if I want to pay out yield or if somebody needs to redeem this instrument at the issuer, I would also need to KYC those participants, but they might be able in the meantime to send this token to Uniswap for trading, for example, without me breaching any compliance issues. You're still mute.
Thank you. So the bridge exists, like you're explaining it, and this is definitely available so that people can issue with a private framework, which can be lighter, and take advantage of the tradability of the asset using the permissionless framework, for instance, the Swiss DLT. Okay, that's a very interesting note to make, everyone listening out there. And okay, so now on a more practical take, let's say, if I was the director or founder of a private business hitting excellent numbers for over a decade, let's say, here in Europe, how should I act to benefit in this market today? What could I put out there? And this can be a securitized item that would have tangible potential to thrive.
Mm. Yeah, I mean, we hear it so often that the largest potential is before companies go onto an IPO, right? The most multiples are gained through the section or the lifetime of a company where it is still private. And once we invest into the SpaceX IPO on Friday, it might already be too late for our 100x. So there's more and more interest from even retail investors and professional investors, even though, to invest into earlier stages, SMEs, high growth fintechs, high growth startups, which are like Series A, B, etc. And two practical approaches. One might be a tokenized convertible note to make it very specific, or another one could be a tokenized profit participation right. So it is a token which does not pay out a fixed yield, but instead it is a debt instrument which very much acts like an equity instrument. So I, as a token holder, would be eligible to receive and demand part of the revenue which the company is generating. And such instruments have already been sold many, many times in a tokenized form across Europe in the past. So I would say that is the most practical approach. And even though perhaps there's even potential to combine these. So if there's a plan to do an IPO and go public, but it's further down the line, let's say in 5 years, right? A convertible note might be the way to go and give existing clients an opportunity to invest, at an preferred share price with a discount. And if there's already a lot of profits done, and there might be no ambition to go public anyway in the next few years, I'd say a profit participation right might be a good instrument to think about, especially again if there's already an existing client relationship ecosystem you can tap into. So yeah, I would advise to think about those two options and evaluate which is best suited.
Okay, very, very, very good information here. I mean, for anybody out there that has the potential in their company to issue something like this, it's definitely possible. And a bit to pry a little bit on what you were saying there, Phil. If they're issuing a profit vehicle, isn't there the risk of, well, the actual risk of the asset be much higher in analytical financial terms than it would be if it offered a straight flat debt yield?
Absolutely. Like it is, if I don't make any profits and I hold a profit participation right, the actual yield might be zero, right? But this is the beauty and the risk at both time on investing into SMEs, high growth companies, which are still private. And of course, transparency is also a subject you would need to think about. So some of the issues I have advised in the past, or where I was involved in transactions, have put, so to say, some transparency obligations upon themselves, because risk is okay as long as it is calculated risk. If I have unknown risk, which I cannot oversee and which I cannot validate, that is a, so to say, real challenge. But as soon as financial data gets transparent, like it is as a publicly listed company, right? There's a legal requirement for me to publish quarterly reports, etc. But the same can be true for an issuer, which issues a private company, which issues a profit participation right and obliged to some transparency obligations outside of any kind of listed rules. So as long as as long as I am as issuer give my potential investors the opportunity to evaluate independently those kind of risks, I think you'll be fine, right? As soon as it's more like a black box, you'll get problems to really find adoption for such instruments.
Okay, so that avoids problems with adoption and gets the work done. Understood. So we're putting quite the puzzle together here, Philip. Thank you for all your responses. These are very engaging details, and to most of our audience, perhaps quite novel information. So when we look at tokenization from its essence, maybe at least for some of us, it held the promise of democratization of asset trading. And this is something that at the highest levels has always been privy to the funds industry, and its access, well, firmly gated. As we have these newcomers of yield vehicles coming into the space through digital assets, how are the yields changing? And do you see their general distribution becoming less rigid, coming from the traditional sense?
So the yield is always a product of risk, and that is more of a mathematical reason more than it is a technical reason. So the more perceived risk an asset has, the more potential yield it has to offer to attract any kind of adoption. And this won't be changing just by, oh, you have a digital token and you can use it in your wallet, right? Perceived risk will still be very much similar. But what is added is a whole ecosystem and composability around this financial instrument. And this starts with simple opportunities like leverage. If, for example, I want to invest with leveraged capital into a traditional fund, this is not so easily possible. And at today's capital market needs, for most of the assets, some kind of personal relationship with a private bank, for example. So if I'm a customer of JP Morgan, they would allow me to invest into mutual funds or any other yield products with their capital. So I'll leverage my relationship, I'll leverage the company, the capital of JP Morgan to invest. This is something which is like a private bank does offer. But this is also something DeFi offers. I can pledge my fund share, for example. I get USDC, and with this USDC from the lending protocol, I again invest into my fund share. And this I can repeat as long as the lending cost is below the yield which my fund share, which I'm acquiring with it, provides me. And this enables me to build leverage like an ultra high network individual would be doing with JP Morgan or Goldman Sachs. So in that kind, these kind of possibilities the financial market is providing, that is already democratized by tokenization. And we see this with many, many things. For example, you and I, we couldn't be a market maker for Tesla on a public exchange, right? We just can't. And we cannot participate in such. But what we can do is provide liquidity on a decentralized exchange as part as an LP, to a liquidity pool. So I can get my tokenized Tesla stocks or tokenized fund shares or tokenized debt instruments and provide them as, so to say, market maker to a decentralized exchange and generate some perhaps additional yield on my Tesla stocks. So again, there we have real democratization, which has not been possible in traditional markets, at least not for the smaller investors.
Well, this alternative access definitely unlocks a lot of possibilities, and you just touched on something that is a little bit speculative, but a very explosive asset, which is the not asset, but I mean feature of digital assets, which is the looping strategy there you mentioned, where you can just live in the difference of yield between the debt vehicle you own and any lending protocol that'll give you something cheaper. And yeah, that definitely unlocks high net worth individual characteristics of the system to where it's not been accessible before. Fantastic.
Absolutely.
All right. And well, in full disclaimer of us telling anybody potentially hearing us to go and invest in any digital assets, so that is not what we're doing here, being very, very clear. How do you see this opening for everyday people, the trading of RWAs, its evolution in the near future? So your prediction, we could call it, and we can close on that since we got a few more minutes, but that'll be the last one. So you're off the hook after this one, Phil.
No, sounds good. One prediction I want to make is access to RWAs, and especially trading to RWAs, will be becoming wallet native. And this is something we are already seeing coming into pieces. So for example, I fire up my MetaMask wallet and I can swap between my USDC into a tokenized fund share, tokenized debt instrument, or, which is already possible today, into a tokenized form of a Tesla stock in my wallet without the need of being signed up to a third-party exchange. The second prediction is that any or every large centralized exchange will be entering the competition not only with neo brokers and smart brokers, but with the exchanges itself. So I do believe that Coinbase, a Binance, a BitGet will be becoming real competitors, even in regulated spheres of, for example, the New York Stock Exchange or the NASDAQ, because they are native. The infrastructure is native to 24/7, native to instant settlement, native to stablecoin-based trading, native to wallet-based trading. All of these features will need to be developed by the incumbents, like NASDAQ, New York Stock Exchange, have announced they are working towards that future. But they will find a world where there are global competitors who have been specialized in this market since the last 16 years now. So they'll wake up to a different kind of reality.
Sorry to interrupt, but these TradFi vehicles have been spoiled by the no competition or everyone playing by the same rules that limits interactions. So they're unbothered, and now they're coming into a ring where all the fighters are already doing that. So it's them that need to catch up in that sense, just like the crypto native ecosystems had to catch up with regulation. But now that they have, I agree with your point of view that these traditional ecosystems now are bearing the brunt of the load.
And who will profit from this in the end? It's us, the consumers, because it has always been the same. Competition leads to innovation, and innovation will ultimately lead to a better user experience. So I think this development is very positively for the general public.
I agree with you, Philip, and excited for things to come. I mean, being someone embedded in the space as you are, these are things we follow up on a constant basis. But I mean, from an outside point of view, I hope our audience found the exchanges here engaging. Very happy to have had you here today. Super interesting talk, Philip, and look forward to running into you soon in one of the next crypto events, maybe Dutch blockchain or something later in the Asian season. But as always, great talking to you. Everybody in the audience, thank you for joining, and have a great rest of the week, everybody. Until next time, thank you.
Thanks for having me.
Adios.
Bye.